Behind the nickel mess on the London Metal Exchange. The London Metal Exchange halted nickel trading and cancelled trades as prices of the metal used in the manufacturing of stainless steel and batteries for electric vehicles more than doubled on March 8 to over $100,000 per ton. The unprecedented price surge followed the massive squeeze on the world's top producer, Russia, following its invasion of Ukraine. The investors and industrial users scrambled to buy contracts on concern of disruption of supply, leading to the largest ever crisis in the 145-year-old exchange in decades. So what is LME? The London Metal Exchange is a futures and forward exchange with the world's largest market in standardized forward contracts, future contracts, and options on base metals. The exchange sets global prices for commodities such as copper and aluminium and trades about $64 billion in future contracts daily. The LME's history dates back to early 19th century when metal traders drew a circle in the sawdust on the floor of the Jerusalem Coffee House in the city of London. In addition to its electronic market, it's one of the last exchanges with an open outcry trading floor, known as the Ring, where brokers gather in person to yell orders at one another for part of the day. Its participants are a mix of the industrial metals companies which tap the market to offset their price risk and hedge funds, which use it to speculate. Still, contracts on the LME are backed by physical metal in a network of warehouses around the world, providing a direct link with the real-world metals industry. So what exactly went wrong? Nickel prices on the LME spiked 250% in little more than 24 hours, leading the exchange to suspend trading on March 8 for the first time in 3 decades. The seeds of the crisis had been planted by a Chinese tycoon, Zheng Guanda, and his closely held enterprise, Tsingshan Holding Group Company, a dominant force in the world's nickel and stainless steel production. Tsingshan Holding Group owned a collection of banks and brokers, $4.5 billion for margin payments related to its trade after the LME scrapped nickel trades made on March 8th. Tsingshan had been shorting nickel, betting that prices would fall because Zheng expected that a rapid production increase in his Indonesian factories would weigh on global prices. Then came the invasion of Ukraine by Russia, a major nickel producer, which was followed by a raft of economic sanctions against Moscow. The expectation that the disruption would drive nickel prices higher fueled a short squeeze, a term for what can happen to people who have bet on a price falling when it rises. Short sellers and their brokers have to buy back the securities they have sold in order to stop the losses, accelerating the increase. The LME has been asleep at the wheel, said Andrew Michael, director of nickel research at Wood Mackenzie, a consulting firm. It got to a point where there were things going on which were not normal market forces. So what did the LME do? When nickel trading spiraled out of control on March 7, then LME suspended the market and wiped out $3.9 billion in transactions the next morning, infuriating traders who had bet on nickel's price rise. The shutdown left nickel companies rudderless for over a week before limited and chaotic trading activity resumed on 16 March 2022. The chief executive officer of the LME defended the decision as necessary to protect market stability, saying the prices were becoming disconnected from physical reality. What happened in the reopening? LME suspended trading in nickel for a week to give market participants, including Zheng, time to get their financing in order. But its first 3 days of trading, from March 16 to March 18, produced short sessions hampered by technical glitches in which only a handful of trades were conducted before a limit for price swings was hit. When trading was allowed, there was a gulf between bids and offers, leading to highly illiquid trading conditions in the world's benchmark pricing venue. So what does it mean for the pricing of metals? Nickel is a crucial element in the stainless steel used in everyday appliances, but it's also important for the world transition away from fossil fuels. Higher prices for nickel means higher costs for the battery makers and auto giants in the midst of electrifying the world's car fleet. What does this mean for the LME? The nickel crisis is threatening the LME already. Some angry investors have said that they will walk away from trading on the market, which is owned by Hong Kong Exchanges and Clearing Limited. In private, exhausted traders and brokers, many of whom worked around the clock for several weeks, expressed their exasperation with the glitches on the exchange's electronic platform. To make matters worse, many were stuck holding long positions they couldn't redeem because the markets had barely traded. The LME is a telephone-based market which is favored by bank, hedge funds, and trading houses with large and complex orders to place. Long before this crisis, there were questions about the long-term viability of the LME, which saw its trading volume slide to the lowest in a decade in 2021 after closing the ring temporarily during the pandemic and shifting toward electronic trading. So, what is the alternative to the LME? Despite the turbulent stop-start trading of nickel on the London Metal Exchange, frustrated investors who may want to shift their business elsewhere have found that there are no quick and easy alternatives. Amid the chaos, some pointed to Shanghai Future Exchange, where there have been such interruptions to nickel trading as a de facto benchmark. Trading on SHFE is difficult for non-Chinese who need an affiliation with a Chinese entity. Then there are differences in currency and language and adjustment for duty and VAT, traders said. Shanghai also has a lot of small-scale retail speculators, whereas the LME is dominated by financial institutions, producers, and industrial users. Another possibility is the CME Group, launching a nickel contract alongside its successful copper futures. Although it has rolled out contracts in aluminium, zinc, and lead, they have so far failed to gain momentum. Copper performs strongly on the CME because its contract with a traditional monthly settlement date is easy for hedge funds and speculators who often use the metal as a proxy for the global economy. Complex LME contracts, in contrast, allow trading any single day for the first 3 months, set up to allow miners and industrial consumers to hedge physical shipments for odd periods. The physical basis of the LME, which is owned by Hong Kong Exchange and Clearing Limited, will make it difficult to dislodge the exchange from setting global benchmarks despite the current disruptions.